Hello, Mike Swanson of WallStreetWindow.com here. If you would, hit the like button on this video so that I know you're there. And it's cool to give good feedback to people on YouTube. Now, it's about 30 minutes till we hit the opening bell today. And I thought what I would do very quickly is show you one of the stories I'm watching very closely today. So I think it's going to have an impact on the financial markets by the end of the year. Maybe not tomorrow, maybe not next week, but I do think it's going to be a key indication of what's to come. Now, I got it on the website, and every morning on Wall Street Window, usually by 9 o'clock or 8 o'clock even, make a couple blog posts. But I also will post the most interesting stories that I'm following that morning that have caught my attention. I usually post about a dozen of them. Make note of this one. Fed's Evans says worth waiting until year end to assess next rate hike. So this Fed official is talking about we're going to wait to December before we raise rates again, and maybe not. Keep that in mind. And I'll get back to it in just a few minutes. But really, one of the key story I want to bring to your attention is this one. I actually posted it yesterday on WallStreetWindow.com. And it's a story on Zero Hedge about the Chinese yield curve now becoming inverted. Now, let me explain what this means. This chart here is showing you the yield on the 10-year Chinese bond, government bond, and the yield on the 1-year bond. Now, something funny is happening. The 10-year bond is paying 3.5%, while the 1-year bond is paying 3.57%. What that essentially means is that if you were to buy a 10-year bond, you'd make less interest than you would on a 1-year bond. So why in the world would anyone do that? Well, you certainly wouldn't do it. But it begs the question, why are bond traders moving interest rates in that manner? And the bond traders tend to impact the longer term bonds, and the shorter term bonds are more under control of central banks. What this means is that the bond traders are pushing the yields on the long-term debt down in the expectation that the shorter term yields are going to follow and drop. That means they're forecasting a recession, an economic slowdown. They have inverted the yield curves. Typically, when that happens, a stock market in a country will also tip into a bear market. If it isn't already in one, it gets into one within a few months. So this is a huge red light on China and the Chinese economy. Now, what's funny is that there's a quote in the article here where the Chinese news agency made note of this development and just said, "Don't panic." Well, if you are invested fully in a market like this, in a stock market, you basically do want to panic and get out. This is what happened in the summer of 2000 with the bond market in the United States. And in 2006, the bond market in the United States flattened, and it did invert by 2007, going into the end of the year. So that begs the question, what is happening now with the bond market in the United States? Well, this is TLT, which trades opposite of the 20-year yields on Treasury bonds. And a funny thing has happened this year. Yields on long-term debt in the United States has dropped, while at the same time the Fed has raised rates on the short-term yield. So the yield curve is flattening. It's not inverted as the situation is in China, but because the gap between short-term and long-term rates has narrowed because the long-term rates have gone up, and they actually went up higher yesterday, that's making the Fed see that they're going to have trouble raising rates more going forward. So we're likely at the end of the Fed tightening cycle, which is exactly what this Fed official has suggested in today's newswire. Although he's not saying that's definitive, he is definitely sending a signal that it's a high possibility. So what happened the last two times this happened in the United States? Well, here's a chart to show you. And the blue line is the Fed funds rate. We have seen two heightening cycles in the past 20 years now. And both times the Fed would reach a point where they would stop raising interest rates. And this is in the year 2000 is the first time here on the chart. And we, of course, tipped into a bear market months following that final rate hike in the fall of 2000 for the S&P and the Dow, and the Fed rapidly began to lower interest rates. Now, in 2006, the Fed stopped raising interest rates about the same time that the real estate prices peaked out. Nothing happened for a year after that. The Fed rates did not change at all. And the stock market continued higher until October 2007, in which it began a very vicious bear market that culminated with a crash in 2008 and a final plunge in 2009. And the Fed rapidly began to lower interest rates once that stock market peak was made, or actually they started doing it in September, right into the peak. So the Fed tends to reverse course in panic, or has created a bubble situation that explodes, forcing them to panic. So where are we at now? If we're at the end of the Fed tightening cycle and the Fed fund futures market says, yes, we are, with less than a 50% chance of a further rate hike this year, then we can expect to see a period of no change in interest rates. And that is not a timing signal that we're at a bear market at this moment, or stock market top at this moment. It's not a timing signal, but it is a warning signal that it's going to come. In 2000, it came within a few months. In 2006, it took 12 months. But it's a warning signal, and we have to be on guard. It's telling us that the economy is not in a position to accelerate as it seemed it was going to after Trump won the election in November. And the stock market is a risky investment for the long run at this point in time because of what the Treasury bond is telling us, the bond market is telling us. Now, it's not inverted as it is in China. That's a situation that's a red alert, very dangerous, very risky now. I would say that the signal in the United States that the bond market is giving us is a yellow sign. And if you're driving a car and you see a yellow light, if you're far away from the signal, you need to start to slow down and stop. If you're right at the signal, yeah, you can go through. How does that apply to investing? Well, if you bought stocks a long time ago, years ago, and have gains, and you're diversified, so all your money isn't in the stock market, and you're spread out in other investment categories, which I think gold is a critical one to own, but you can't have 100% in the stock market. If you're diversified, then you really, are in a good situation. If you're fully invested with no diversification, all you own is stocks, then you're in an extremely risky situation. You are having a yellow sign flash right in front of you and are not slowing down. And easily, I think people in such a situation are going to get into a wreck when it comes to their financial situation. Now, I'm watching other things, of course. I don't look at this one indicator. I'm looking at technical patterns of the stock market. I talked about in the last video I did Bitcoin, how it's moved, and how a lot of the most popular technology stocks have actually been moving with Bitcoin in the past 60 days. So watch that video if you have not seen it. Subscribe to this YouTube channel to get my future video updates, and I'll be talking with you later.